Let's take it back to the 1980s, during the tail end of the Cold War, and observe how the rise and fall of states is connected to natural resources. In the 1980s, the stage was set for the downfall of the Soviet Union, as even the centrally planned economy relied heavily on the export of crude oil as a source of trade. This reliance would eventually contribute to the downfall, as Saudi Arabia, perhaps in coordination with the United States, flooded the market with supply, pushing the price of crude lower and lower. This devastated the Soviet ruble, eventually leading to the bankruptcy and the subsequent demise of the Soviet Union. These events are particularly relevant today as we see the price of oil collapsing and watch the Russian ruble plummet alongside. Welcome to the Big Trade.
You are now listening to The Big Trade with Peter Pham, enlightening conversations for maximum market returns.
Welcome back and thanks for tuning in. I wanted to take some time to release an episode before the new year, which was to address the price of crude oil and its impact for oil companies, financial companies, and the impact it's having in terms of geopolitics. The purpose of the actual introduction was to highlight the parallel that we see happening in the global economy today and its impact that it could have on both Russia and Iran. So I got a chance to sit down with a gentleman named Gary Dorsch, a specialist on intermarket analysis. And I think that some of the thoughts and ideas that he puts together helps put together this whole picture and framework that we discussed about on the previous episode, which was to develop a paradigm and investment thesis in terms of your portfolio. I also wanted to take some time to thank everyone for listening in. You can now find The Big Trade Show on iTunes in the investing section or using one of your podcast apps. So without any further ado, let's introduce you to Gary. Thanks. I'm here with Gary Dorsch talking about global markets. He has very interesting insights. Gary, maybe you can introduce yourself to the audience.
Sure, Peter. Thank you very much for having this interview, this discussion this morning. My name is Gary Dorsch, and I am the editor and publisher of the Global Money Trends newsletter. And I've been publishing the newsletter now for 9 years. And what the newsletter essentially attempts to do is to collect all the information that comes into the marketplace throughout the week and try to put it all together into a simple, easy-to-read analysis so that the letter can be read after the close of the markets on Friday evening, after the close of the New York Stock Exchange, and when we have a little time to rest and recover from a whole big week of wild and woolly trading in the markets, and to try to get some focus on where the market might be heading next. The newsletter covers a wide range of topics, but primarily on foreign currencies and metals and interest rates and stock markets and in many different countries. And what we're attempting to do, at least, is look at what are really the biggest movers in the markets at any given point in time, and give it a different twist, because the newsletter contains a lot of charts that you basically can't get elsewhere. And the charts are devoted to what's known as intermarket technical analysis, where we'll show at least 2 or possibly 3 different markets all in one graph, and show how they all are interrelated with each other and how one market can affect another market. And so the reader gets the visual display of a chart, and along with it, commentary to explain what they're seeing in the chart. And along with that, maybe news and information that you're not aware of or had not yet heard of. And so it is quite a process of collecting the data and then compilating it together, synthesizing it together, and trying to lay it all out there each week in easy-to-read format for even someone who is not an expert in finance. So it can be very educational in the sense that even if you are not familiar with the market, how it works, this newsletter will actually teach you how the market works. If you read it regularly and for a 6 to 8 month period, I think you'll be somewhat self-empowered expert in international finance, and you'll certainly have a lot more knowledge and information than the average person who doesn't have much interest in the markets. But in any event, that's what the newsletter attempts to do, and we are, at least for now, heavily focused on the crude oil market, which is gaining the attention of traders throughout the world. And this is certainly quite a historic event, probably the biggest historical event, I think, since the crash of the stock markets in the fourth quarter of 2008. So here we are 6 years later, witnessing yet another major meltdown in a sector of the market which has different implications for different industries. And so most recent newsletters have been focusing on the crash in oil and just why it's happening, and the impact it's having not just on the energy sector, but on other sectors of the economy and the markets as well.
So, Gary, what can you tell us about the oil contagion that's happening? And in terms of your intermarket analysis, what insights have you been able to capture from this oil contagion?
Well, what was interesting is that for the past 3.5 years, the price of crude oil was averaging between $95 and $110 a barrel. It was relatively stable. In fact, we had not seen oil prices so stable for so long, for quite some time. And beyond that, the price of crude oil was averaging just over $100 a barrel, which is something that had never happened in history before. Although we had seen the price of oil go to $147 a barrel briefly in 2008, in July of 2008, it didn't stay up there for very long. It began to implode and eventually fell down to as low as $45 a few months later. But the average price throughout the year for the last couple of years has been just over 100, and the world economy has never, ever had to sustain such development before. And as a result, a lot of investments in the last few years were made on the assumption that the price of oil had now hit a new normal, and that the new normal was somewhere between $95 and $110 a barrel. And a lot of money and investments were made based on that assumption. So one of the things that has become apparent now, with the price of crude oil having suddenly collapsed without warning, without anybody really having seen this happening, or very few, if any, we've seen the price of oil drop from just over $100 now down to just under $60. Closing in New York on the New York West Texas Sweet contract at $57.50 a barrel. And there's different blends of oil. The one that is really even more important than the U.S. Texas blend is the Bakken shale crude oil blend, which closed at $52.50 a barrel, or $5 less than the Texas Sweet. And then there's another blend of crude oil, the Canadian tar sands oil, which typically trades $18 to $20 a barrel less than the U.S. Texas Sweet, and that's closer to $40 a barrel. The thing is, a lot of investment decisions were based on the idea that oil would stay around 100. And what we have seen here in the last 4 years is that the United States increased its oil production by 4 million barrels a day compared with 4 years ago. And this type of oil exploration and development is otherwise known as hydraulic fracking, and it's a very expensive process. And depending on which oil region you're talking about, the cost of extracting oil from shale rock is anywhere from $45 to $100 a barrel, with the average median break-even point of $70. So a lot of folks got into the oil business even with a break-even cost of $70 a barrel, thinking that they'd always be able to sell oil for $100 or higher, and that there would be a profit margin. And worse yet, they didn't have the money to really develop these oil fields, and they borrowed the money. We're beginning to learn now that a lot of small companies borrowed as much as $250 billion, or about $250 billion, was borrowed by subprime borrowers, otherwise known as junk bonds. And not only were junk bonds issued and sold, a lot of banks in Texas and Oklahoma and elsewhere made bank loans to these subprime borrowers in the shale oil business. Now we're finding out that suddenly the price of oil has collapsed almost in half, and more than half of these shale oil companies will find themselves losing money at current sales prices. And without the ability to generate a positive cash flow, their ability to pay their debt is now becoming in question. So one of the contagion effects that we are seeing as a result of this collapse in crude oil is the collapse and meltdown of junk bonds that are traded here in the United States on the over-the-counter market. And my recent newsletters, including my most recent one, has some charts and graphs of over half a dozen smaller, lower-rated credit borrowers in the shale oil business who have seen their junk bonds drop to 50 cents on the dollar, 52 to 60 cents on the dollar, and in some cases the interest rates for just 3 or 4 to 5 years out have gone up to as high as 29% if you want to buy these bonds.
So Gary,
and they
this
also
is very
have
fascinating.
Oh, yes.
Gary, this is very fascinating. What do we think is the total value of these junk bonds, and what do we think is the total value of the potential non-performing loans that some of these financial institutions have issued out to these oil companies?
Well, the total size of the junk bond market, which is bonds that are rated less than BBB minus, is $1.3 trillion. And the junk bonds in the energy sector is about 18% of the total junk bond market. So what we've been talking about now is 18% of the junk bond market, or about $235 billion in face value. That's basically, given that the price of some of the weaker junk bonds have gone down by anywhere from 40 to 50% value, we're probably looking at least $90 billion in paper losses for investors who bought these bonds. And beyond that, a lot of private banks that are banks that are publicly listed, regional banks, and as I mentioned, in Texas and Oklahoma, a few have as much as anywhere from 13 to 20% of their entire loans outstanding to the shale oil industry. So we're seeing some very sharp sell-offs in bank stocks on the New York Exchange that have dropped to 10, 15, 20% in value as well. So we see the contagion effect in junk bonds and even in bank shares on the U.S. exchange. And of course, on Friday, the Dow Industrials dropped 310 points, culminating a drop of 678 points for the week. And the S&P 500 dropped 3.5% for the week. And these are, of course, coming off of record high levels. But whereas the initial impact of sharply lower oil prices was seen as a positive factor for the stock market, at some point we reached a tipping point where the price of oil had gone down too far, in a sense, and then people began to think maybe there's some negative implications behind this drop in oil. And so to answer your other part of your question, these are, of course, very volatile markets. And, of course, commodities in particular are highly emotional, and they're very schizophrenic as well, whereas they can turn sentiment on a dime without warning at any moment in time. And so, whereas we can talk about what's moving the market today, tomorrow there could be a different story that everyone will be talking about. And certainly after a big move, either up or down, nothing does go in a straight line. There's always pullbacks and corrections along the way. We do want to try to identify the major trends, but in this particular case, this collapse in oil was something that I would say is almost a black swan event, something that maybe had a probability of less than 3% of happening, at least to the extent that it has.
So, Gary, in terms of geopolitics and this global oil contagion, what do we know about what's going on in terms of like Iran and Russia, for example, major benefactors of crude exports, and how does this benefit the U.S. in terms of geopolitics?
Well, of course, if you read the newspapers, well, let me put it this way, the British broadcasting system does that for me. They do read newspapers overseas, and they translate them into English. And I've been reading some of the commentary out of the newspapers out of Iran, as an example, and they are full of conspiracy theories in which they believe that this is a plot that's been hatched between Saudi Arabia and the Persian Gulf kingdoms of the GCC, who are friendly with the United States, and that this is a plot to bring down the price of oil because it will, if this decline in oil is sustained for an extended period of time, could deal a crippling blow to the Iranian economy, and could be mortally wounding as well to the Russian economy. And so the newsletter that I write has gone into a lot of detail looking at the economies of Russia and Iran and their foreign currency reserves and their the amount of spending that they do at the government level. These governments are basically subsidizing their population, especially in Iran. The Iranian government subsidizes the cost of food and energy. You can buy a gallon of gasoline in Iran for about 38 cents a gallon. And here in southern Florida, where I live, it's still about $2.70 a gallon. And so the difference is that the government of Iran is buying gasoline and selling it at a very low price to the population. Their ability to buy the gasoline comes from their sales of oil. That's how the gasoline is purchased. And same for food and other vital imports. But if the government loses its income, if its income drops in half, and it's already been hurt badly by sanctions which have limited their sales of oil, we could see a point in time where the Iranian government is forced to reduce the subsidies, and therefore the average person will have to pay 2 or 3 times more for food and energy than they're paying today, and that could deal a crippling blow to the economy and lead to a lot of social unrest. And whereas we saw Arab Springs in various Arab countries in the last few years due to high prices of the cost of living, the same could happen in Iran. So if the price of oil stays at $50 a barrel for an extended period of time, and I would have to say for at least a year, if that price of oil does stay down for a long period of time, then 1 year from today we could be talking about a revolution in Iran that overthrows the Ayatollah of Iran. And so this may be the way to prevent Iran from acquiring nuclear weapons, as opposed to taking military action to hit Iran's nuclear installations, which could lead to widespread warfare throughout the region. This may be the alternative route through economic strangulation. And of course, Russia is also in a very severe situation. Russian companies, which are often owned by the government itself, have about $560 billion of debt owed in foreign currency, and of which $150 billion comes due next year. And the ability of the Russian companies to finance their debt now would be in question, as the Russian ruble has dropped by nearly half. The Russian ruble has dropped in half compared to the U.S. dollar, trading at 58 rubles to the dollar. And so the Russian companies that need to acquire dollars in order to pay off their debt now must pay almost twice as many rubles to acquire the same dollar, which essentially is doubling their cost of servicing the debt and paying back the principal, therefore raising the probability that they may default on debt as well, and lead to severe economic consequences in Russia. And Russia's ability to sustain such a development is all based on its $420 billion in foreign currency reserves, which is a very large stash of money. But at the current rate that it's going and trying to defend its currency, and if it was to have to be the lender of last resort to Russian companies, that money could run out in about 2 years, and then Russia could be back on the verge of collapse as well. So when we talk about geopolitics, of course, Russia and Iran are, in the eyes of the West, two of the worst bad actors. In fact, Russia and Iran have become very close in recent months, signing an agreement in which Russia has agreed to buy 500,000 barrels of oil a day directly from Iran in exchange for Russian manufactured goods. So the two countries, Iran and Russia, now have a barter agreement in which Russia will sell barter manufactured goods to Iran and in return get paid in Iranian oil. And then Russia will turn around as a third-party middleman and sell the Iranian oil on the marketplace, which will add to the excess supply of oil, but also give Iran a way to evade sanctions that have been put upon it by the Western countries. And so one way to put a nail in the coffin of this arrangement is to drop the price of oil. And Saudi Arabia in particular has the power to enforce low oil prices if it should choose to do so. Saudi Arabia produces 9.5 million barrels a day, but has the capacity to produce additional 3 million barrels a day if it should choose to do so, up to 12.5 million. And should that happen, it would be able to probably enforce the price of oil between 40 and 60 a barrel for about a year's time. And that would be about all that's necessary in order to bring about its objectives of crippling or toppling the Iranian economy and doing a lot of damage to the Russian economy. That would be the geopolitical viewpoint of that. And that, of course, is something that is not often talked about on the surface. On the surface, what we hear is that the Saudis are letting the marketplace determine the price. they have nothing to do with what's going on. And another saying that this is really taking aim at the U.S. shale oil industry, but in reality, behind the scenes, privately, this is all about trying to deal a crippling blow to Iran and Russia.
Excellent. In regards to iron ore, you also mentioned the same characteristics are happening in that market as well. What is it that you're noticing happening in the iron ore market, Gary?
Well, the iron ore market is it's an interesting market. It's not widely followed in the United States because there is no futures market for iron ore in the United States. There is a futures market for iron ore in Singapore, and there's one in London. But primarily it's traded in the spot market in Shanghai, which is the biggest user of iron ore, which is a key ingredient for making steel. And steel, of course, is used as a key mineral metal for construction, especially for the infrastructure boom in China and elsewhere in emerging Asia. Iron ore is the most heavily exported metal in the world outside of crude oil, and when you do look at the Baltic Dry Index, for instance, iron ore is the most actively traded metal. So it is an extremely important market, and it tells us a lot about the health of the world economy because it is so tied in with infrastructure and construction. And we could also say copper has similar characteristics. So these two cousins, I say, are give us some indication of the health of the global economy as well. So they're good barometers that we can look at. And the price of iron ore hit a record high of $180 a ton when the world economy was growing about twice as fast as it is today. And today the price of iron ore has dropped to a 6-year low of just under, about $68.50 a ton. 1 year ago, it was at $140 a ton, and then 1 year later, today, it's at just under $70. So it's a similar situation where it's dropped in half. What makes this different, however, is there are three miners, BHP Billiton, Rio Tinto, and Brazil's Vale, which control 80% of the iron ore market, and the others are smaller miners in Australia and others in China, a few in Canada, and a few elsewhere. But I began to notice, as I started writing in my newsletter last Friday, that for the first time, only in the last few weeks, are we starting to see the world's largest miner in iron ore, Vale, starting to see that its bond prices are falling. And as its stock price fell to $7 a share, you can track Vale under ticker symbol VALE. And that is below the low from the March 2009 lows that we saw at the nadir of the Great Recession lows. So this stock is at extreme low prices compared to where it's been historically, and even in worse condition than it was during the Great Recession. And in the last 2 months, the yield on Vale's longer-term bonds has increased by about 137 basis points, or about 1 3/8% higher, as the stock prices move lower and as the price of iron ore has moved lower. And in another market called the credit default swap market, that is where traders pay for insurance to insure against the possibility of a default by the borrower, in this case Vale. Cost of purchasing insurance against a default by Vale has doubled in recent weeks. So we're seeing contagion in a certain respect in the iron ore market as well. In other words, crude oil, iron ore are telling us that the world economy, and maybe China in particular, is much weaker than what the official government statistics are saying. And I would advise everybody should always look at government statistics with a healthy grain of skepticism, because they are manipulated and fudged to a certain degree by bureaucrats, and to a certain degree they are used as propaganda tools to tell the masses at large that conditions are maybe better than they actually are. Luckily, we do have markets that we can watch, and while you can fool the market for so long, eventually the truth will come out. And sometimes when you see these radical shifts, such as what we're seeing in the oil market today, it could be indicative of a market that was being fooled for a long time and thinking that the world economy was actually in much better shape than it really actually is. And now reality is starting to dawn on the market. And I was reading some commentaries by some traders who said the reason the U.S. stock market dropped as much as it did last week was because some folks are saying that maybe this decline in oil is a signal that the world economy is not doing as well as has been previously assumed. This is all part of the marketplace, though, and so it is what it is. And the newsletter basically lets everybody see how all this works out.
So, what did you think? Gary had actually mentioned to me that perhaps some of his answers were a little bit more long-winded. And what we decided to do was to break this episode into two parts. The second part is probably equally as interesting if you actually listen to the content. We discuss about oligarchs and their role in the economy, and the role that plutocrats and technocrats have in the economy as well. We cover many different investing themes and intermarket analysis as well. So I like to release that second episode in the not-too-distant future. I hope you enjoyed yourself and look forward to speaking to you sometime soon. Take care.
We hope you enjoyed this mastermind session. If you'd like to contact Peter Pham or Phoenix Capital, please email info@phx-cap.com.